Imagine one day your company is worth $47 billion. It is the poster child of a successful startup, insane amounts of venture capital, a fantastic culture and recognition all around the world. Then a few years later, it all comes down crashing hard. Your company's now worth barely $100 million. Failed business model, no grasp of the fundamentals. It turns out it was all smoke and mirrors. This is the story of WeWork. Hello everyone, my name is Antonio. I'm a finance manager at Google, and in this channel we talk about the latest trends in business and technology. I almost worked at WeWork as a finance director in 2019. I remember taking the Eurostar from Paris to London and going through the little publicly available information I had. I went through the valuation once, twice, thrice. I couldn't get my head around it. To me, it sounded just like another real estate company providing office space. But the money was good, so I ignored my spidey sense and decided to give it a shot. I arrived at the offices and was amazed at the amount of glamour around the office. Free drinks, free food, game room, friendly staff, almost like a night out in the town. I loved it. But in the back of my mind, I was still wondering what they did and why there was so much hype about the company. I managed to clear every single interview round, but they went with someone else. Looking back, this was definitely a blessing in disguise. And why is that? Let me show you. WeWork or WeDream? First, let's answer one important question. How did WeWork actually work? Their business model was predicted on the idea of taking long-term leases on commercial properties, refurbishing them into modern co-working spaces, and then subleasing them on shorter-term contracts. A lot of their members were startups and freelancers, but some of the tenants were big companies such as Facebook and Microsoft. The appeal was clear. Flexible working spaces with modern amenities that businesses could use and without committing to a traditional lease. Great idea, right? The gig economy and remote work came at a perfect time. And just like adding wood to the fire, business started booming. Okay, so now that we get how they make money, but now let's answer another important question. What's wrong with this picture? If you think about it, what WeWork was fundamentally doing was rent arbitrage. In concrete words, you lease a building for 15 years at one rate and sublease the space to members on a monthly basis, for example. The logic here is that the revenue coming from the volume of short-term memberships at a certain price point will surpass the long-term lease payment for the same period. However, this is very risky because it creates a duration mismatch. In other words, if the economy goes south and people abandon their spaces on short notice, remember that they're paying on a monthly fee with cancellation rights, WeWork will see a decline in revenue while still being liable for the long-term lease obligation. That would create a lot of pressure on cash flow, but also on profit. And it did. The company was burning cash and losing money at the same rate as revenue was going up. It was definitely not a good story, not even a good dream. At this point, you should have noticed two things though. The idea might sound great, but the business fundamentals sound very risky. But most importantly, I never referred to WeWork as a tech company. Huh? Yep. WeWork was considered a tech unicorn.
Another tech unicorn has filed to go public. This time it is WeWork, now known as the We Company.
Not just by the CEO and the staff, but also by some of the biggest investors in the world, namely SoftBank, a $47 billion lie. At its peak, WeWork was valued at $47 billion. To put that number in perspective, companies in the same industry like CBRE or IWG were not even 10% of that. So why would these guys be treated differently? Well, the answer is simple. WeWork believed they were a tech company, and Adam Neumann, the CEO, would harp on this every single chance that he got. In fact, the word technology appears 93 times in the prospectus they filed with the SEC at the time they were going public.
I think if you have to use the word technology in your S1 more times than Facebook and Google didn't have to. I agree with Jeff. I mean, it's a real estate company.
I shit you not. Do a Control F on the S1 and you see for yourself. The valuation was primarily based on growth metrics and the potential for future profitability rather than present-day financial health. Their favorite metric was the infamous community-adjusted EBITDA. Tech companies often receive higher valuations because scaling software doesn't require a huge cost burden. But WeWork was capital intensive. Think of all the property and equipment in every building they leased and the community managers and staff overseeing new member acquisition and overall satisfaction. That's a huge corporate cost that regular tech companies don't have. This was an odd case of extreme optimism on market domination. But many people pushed Adam Neumann's narrative, included in those people was SoftBank's CEO Masayoshi Son, who injected billions of dollars in investments that managed to push the valuation to $47 billion.
Did you want to invest more in WeWork?
Of course. I still want to invest more and I want to increase.
Soon enough, SoftBank would realize this was a big mistake. the house is on fire. Like they say, all good things must come to an end, and WeWork was no exception. After going public, the company went south in many ways. A cut in its valuation from $47 billion to $5 billion. The ousting of Adam Neumann as CEO and 2,400 layoffs across the company. Business challenges of every type came knocking on WeWork's door. Number one, mismatched leased structures. Co-working spaces saw a drop in demand due to recession fears and the latest round of layoffs happening across the tech industry. That fear in the fundamental business model of the company came to pass. 2. Overexpansion. WeWork was known for growing its tentacles fast in the real estate industry. Every week it felt like they had a new office in one of the most coveted districts in countries like Singapore, the UK, and Australia. The problem with that was that global expansion without establishing profitability in those markets is a recipe for failure. Besides, the long-term lease commitment, the retrofitting of each building would accrue massive liabilities that would come and hunt them down the line. And number 3, corporate governance. Adam Neumann was not just the owner of the company, but he was also a tenant. He was allegedly also a customer. This gave the perception of a huge conflict of interest and part of the reason why the board asked Neumann to step down. The issues kept piling up, one after the other, to the point that, as of a few weeks ago, executives have sounded the alarm on whether the company can exist at all. This is known as the going concern principle, and it's accounting 101. And now the stock is practically worthless. Here's an excerpt of WeWork's Q2 2023 earnings release. In a difficult operating environment, we have delivered solid year-over-year revenue growth and dramatic profitability improvements. David Tully, the interim chief executive officer, commented. Excess supply in commercial real estate, increasing competition in flexible space, and macroeconomic volatility drove higher member churn and softer demand than we anticipated, resulting in a slight decline in memberships. Now, all of this, why does this matter to all of us? The importance of accounting fundamentals is crazy. Reporting the inability for the company to continue is a big deal. It means liquidating assets, restructuring the business, and firing people, basically shutting down the whole thing. It speaks volumes about the need for financial literacy in business, especially in an era when it's easier than ever to get a check from investors to scale a business. It says a lot about how investors and founders can get fixated on growth metrics and stories that will supposedly disrupt and revolutionize industries rather than basic profitability and market fit. At some point, income statements, balance sheets, and cash flow statements have to be the signals we take into consideration to running the ship. I don't doubt there was talent in the finance team. I actually met some of them. But this feels like there was a king at the top, and anybody who would disagree with the flow at WeWork would get tossed to the guillotine. Therefore, I can only assume the We generation was more of a dictatorship than a community. A new CEO was just announced, so hopefully he manages to turn things around, and all the best to him and the team at WeWork. If you like that video, smash that like button, consider subscribing, and I will see you in the next video.